For the past 5 months, South Africans have faced a steady increase in the cost of living as the prices of basic goods and services climbed across the country. Much of this pressure originated far beyond South Africa's borders. Geopolitical disruptions in the Middle East created a period of high volatility in global energy markets, using its policy tools to keep price growth within a specific target range. To combat rising prices, the bank raised the repo rate to 7.0%, a restrictive level intended to cool the economy and discourage further inflation. This high interest rate creates its own set of challenges. It increases the cost of debt for households, while making it more expensive for businesses to borrow and invest. Heading into the July data release, the situation was tense. June inflation had reached 5.0%, well above the bank's 3% preference, leaving many to wonder if even higher rates were coming. The July inflation report became the key piece of evidence for the Reserve Bank's upcoming interest rate decision. On August 19th, Statistics South Africa released an inflation report that changed the immediate market expectations for interest rates. Most economists had expected a modest cooling, with the consensus forecast sitting at 4.5%. However, the data showed price growth slowed more than expected. Instead of 4.5%, headline inflation fell to 4.3%. Looking at monthly figures, the shift was clearer. Inflation for July slowed to 0.2%, down from 0.7% in June. This slowing trend was driven by two main factors. First, food inflation eased, providing relief at the grocery store for the first time in months. Second, the intense pressure from fuel prices began to retreat, helping to stabilize costs across the broader transport sector. These figures suggested that the earlier spike in inflation was losing momentum faster than many market analysts had anticipated. Financial markets reacted quickly to the news, adjusting their forecasts for the Reserve Bank's next move over the following 32 hours. One of the most immediate signs of this shifting sentiment was the strengthening of the South African rand. Investors interpreted the lower inflation data as a sign that the risk of another interest rate hike had significantly diminished. Many market participants are now betting that the Reserve Bank will choose to keep the repo rate steady at 7.0% during its September meeting. This slowdown in price growth reduced the immediate pressure on the central bank to continue raising interest rates. For households, inflation at 4.3% means that the cost of living is rising at a more manageable pace, providing a small amount of breathing room. For businesses, the expectation of steady interest rates provides a level of certainty needed to plan for future projects and manage their financing. Despite this progress, 4.3% is still higher than the 3% target the Reserve Bank ideally wants to see. While the recent data is a positive sign for consumers and businesses, the central bank's long-term goal of price stability has not yet been fully reached. Central banks remain cautious as global supply chain risks and energy market volatility continue to threaten domestic price stability. If global oil prices or transport costs rise again, the downward trend in inflation could easily be reversed. Because of these risks, a decision to hold rates in September would be seen as a cautious pause rather than a signal that the fight against inflation is over. If inflation continues to move toward the target in the coming months, policymakers may eventually find they have more room to support economic growth. The stability of South Africa's economy now depends on how the Reserve Bank manages this balance between cooling prices and maintaining the credibility of its financial policies.